Hyperscale Data Inc, ticker symbol GPUS. The name might sound futuristic, like something out of the next tech revolution, but when we dive deep into the numbers, the reality starts to look very different. Let's break down GPUS, one metric at a time, and uncover what's really going on behind the scenes. The market cap sits at just $50 million, yet its enterprise value is nearly $136 million. That gap tells us one thing loud and clear. The company is carrying significant debt or obligations, a potential warning sign for any investor. Now let's look at the share structure. There are about 6.5 million shares outstanding, but here's the shocker. Shares have increased by over 750% in the last year. That's heavy dilution, and it raises questions about the company's funding strategy. Institutional investors are staying far away, with only 0.6% institutional ownership and virtually zero insider ownership at just 0.01%. The public float is only 1.4 million shares, which makes this stock extremely volatile. And speaking of volatility, the short interest is through the roof. A massive 86% of the float is shorted. That's not just high. That's one of the most aggressively shorted stocks in the market. Next, let's check the company's financial health. The current ratio is only 0.27, which means the company doesn't have enough assets to cover its short-term liabilities. Its debt-to-equity ratio stands at a staggering 57x, a sign of extremely high leverage and serious financial stress. And when we look at profitability, the picture gets even worse. While annual revenue is around $106 million, the company posted a net loss of $61 million. Margins are deep in the red. Gross margin is just 22%. Operating margin sits at negative 34%, and net margin is an alarming 53%. Return on equity? A jaw-dropping 202%, which means the company is destroying shareholder value at an incredible rate. Then there's the cash flow. Free cash flow is negative $24 million, and working capital is deeply negative at minus $157 million. Meanwhile, book value per share is just $1.38, yet the stock is trading far above that, suggesting a major disconnect from its fundamentals. So, what's the big picture here? A low-float stock with extreme short interest, volatile, speculative, and a favorite for short sellers, but at the same time, heavily in debt, burning cash, and far from profitability. This raises the ultimate question. Is GPUS a ticking time bomb headed toward collapse, or a short squeeze waiting to explode? Let us know your thoughts in the comments below. And if you found this breakdown helpful, don't forget to hit like, subscribe for more honest stock analysis, and we'll see you in the next one.